This week, I have an opportunity to sit down with my good friend and colleague, Jeremy Lucas. Now, Jeremy's been in the mortgage industry for well over 20 years. I have worked directly with him as a real estate agent for almost 21 years. Now, Jeremy and I sat down and we discussed the recent Federal Reserve move to lower interest rates. They did that on the 17th of September. Jeremy follows this stuff extremely closely, and we had an opportunity to sit down and analyze what this means to home buyers. If you're looking to purchase a home and you've been waiting for interest rates to come down, does this mean that the interest rates are going to be favorable to you? Are you going to save money on a mortgage right now purchasing a home? Jeremy and I get into some of this on a little bit deeper level. He also cautions us that just because the Fed's cut rate, it doesn't really ultimately translate into a real quick decline in rates, nor does it translate into a deep cut in rates. We talk about if a person's life is in a situation where purchasing a home is going to be very beneficial and solve a lot of problems, perhaps a growing family and you need more size, or you need a smaller home to deal with your new life situation, perhaps now is the best time to buy. He points out that people need to marry the house but date the rate. And really what this means is the house is something you're buying that you really need to invest in because it's solving a problem. And it's your longer term solution. However, the rate, your mortgage, is short term. It would allow you to purchase now, even if it's not a favorable rate, and refinance down the road when things are better for you or rates have come around to something that's more economical for you. Without further ado, let's dive in and talk to Jeremy. And again, I'm Shane Davila with Silver Creek Realty Group, and I look forward to speaking to you after the interview.
Be strong.
Guys, today we're sitting here with Jeremy Lucas with Willamette Valley Bank. And he's a lender that I've worked with for over 20 years now. He's been in the industry even longer than that. And if he can't solve the issue, then there is no issue. We've done probably hundreds of transactions together over the years. And Jeremy's come through really well. So, Jeremy, I think the news speaks for itself about the Fed's cut interest rates. What does that all mean anyway?
Yeah, good question. And as far as the Federal Reserve cutting rates last week happened on September 17th, they cut the Fed rate by 0.25%. And so I'll just kind of go through my notes here, but basically bringing it down into in the range of what's like 4 to 4.25 is where the Fed rate range is now. And so it's a pivotal moment because the Fed has been holding rates steady for so long, and even this whole year, which was between 4.25 and 4.5 previous to this cut, and following previous years' rate hikes to try to combat all this inflation and things like that. So, which it's now kind of cooled down to under 3% on inflation. So this initial rate cut basically is reflecting a shift to support the labor market amid slowing job growth. Fed Chair Jerome Powell basically noting there's downside risk to employment, meaning it could get worse, which has also prompted the rate cut as well. But most analysts expect at least another 0.25% rate cut by the end of the year, if not a couple. And so this is basically just like a cautious approach to the economic situation. They don't want to cut it too much. But for everyday people, this offers a little bit of rate relief. Really, the impact is going to unfold as it influences your borrowing costs. And so really, it's affecting like short-term rates, like car loans, HELOCs, credit cards, things like that, is where the direct effect comes from. But we also see it affect the long-term mortgage rates as well, indirectly.
Okay. So I think when people in our industry, when people hear that the Fed's cut the interest rates, we're thinking, oh man, okay, maybe it's time to go buy a house. So in terms of how it reflects with purchasing power, lowering mortgage interest rates, how much would this help a buyer who's been holding out on purchasing a home because interest rates were too high and they really couldn't qualify for the mortgage that they needed before.
Yeah, no, and that's a good question, common question. It's over the years, every time the Fed cuts the Fed rate, we get bombarded with phone calls. Hey, I heard interest rates just went down, all that kind of stuff. And
Yeah.
like a broken record, I've always just explained over and over, it's not mortgage rates, it's not long-term mortgage rates, things like that. It's short-term rates. Now I've just embraced it. So we send out an email to everybody saying, hey, the Fed just cut rates. What's that mean for you? Because they inevitably just always think it's interest rates for mortgages that have been cut. But yeah, what does this mean for mortgages? Basically, mortgages aren't tied directly to the Fed funds rate. That's more influenced by what's called the 10-year Treasury yield, which I'll show you something here in a minute, as well as mortgage-backed securities is the main catalyst of what actually directly affects mortgage rates. A couple of weeks ago, leading up to the cut, we saw 30-year fixed mortgage rates drop a little bit down into the mid to low sixes, down from the upper sixes a month before. And so even experts like Freddie Mac, they predict another 1/4 to 0.5% drop in actual interest rates, potentially by the end of the year, if the Fed rate cuts continue. But again, not directly affected. But for lenders like myself, this just means more competitive pricing on everything from conventional loans, VA loans. And so
Okay.
somebody could potentially, let's save $100 to $200 a month on a $400,000 loan. But my advice is we don't want to wait for rock bottom rates. So it's always lock in now if you're ready. A secondary market investors might price future cuts prematurely, which I'll go over here in a second. But basically think of it as the Fed is greasing the wheels for mortgage to get smoother. The timing, your application is going to be mostly important. And so let me see if I can share my screen here, Shane.
Yeah.
So this is basically what I
There we
look
go.
at each day. So this is following mortgage-backed securities, the mortgage bond market, like we talked about, and then also the 10-year Treasury. So these are the two things that are really what we follow and track for what we think interest rates are going to do. So let's look at the mortgage-backed securities bond market. So right here, I'm going to go to September 17th. This is the day the Fed cut the rates by 1/4%, right? So let's look
Yes.
at the previous 2 weeks leading up to that, all the way back here. So this is where we really got a good idea where the percentage of the odds of them cutting became very strong, whereas basically a shoe in that he's going to cut rates. Well, the markets are forward looking. And so with anticipation that the Fed is going to cut the rate by 1/4%, a lot of money poured into the mortgage bond market, which is what we're looking at here. So the mortgage-backed securities, just to give you an idea, as the value of this goes up, this brings interest rates for mortgages down. So this is, we want to see green all the way up. But we see how to kind of tie in how Fed rate cuts do affect mortgage rates, which isn't directly, but it's preemptive, right? So the sentiment was rates are going to get cut, the Fed rate. So the mortgage bond market was just on a rally for 2 weeks straight. So between this 2 weeks leading up to the rate cut, we saw probably almost 0.5% betterment, 1/4 to 0.5% betterment in mortgage rates, just in the anticipation. And so then we get the Fed rate cut this day, and everybody's thinking, too, like, oh, it's just going to continue to perpetuate the bond market. Rates are going to continue to go down. Well, look what happened here. The bond market took a little nosedive here. And what happened is, coincidentally, within that same day, some other economic data came out that was bad for mortgage bonds that pushed the market down. And so just to give you an idea, good economic news or higher inflation or things like that is what is the enemy of the bond market. So if a good jobs report came out or things like that, or even a little bit higher or higher inflation numbers came out than expected, you see a big drop in the bond market. So we just had some bad news that happened. And so over the last week or so, week and a half, we saw interest rates give back at least 1/4% of those gains that we made. So that kind of goes back into what I was saying previously, is that if you're ready to go, if you think rates are in a relatively good spot, you're ready to buy, don't wait for rock bottom rates. Everybody's waiting for that rate cut, but they missed all the gains that we had all the way leading up to it. And then we lost about 1/4% of rates just since then. So you might have lost an opportunity to lock in at a good time thinking, oh, the Fed's going to cut the Fed rate, rates are going to get better. And they didn't, temporarily. Now, long term, still definitely expect interest rates to get better, but there's absolutely no guarantees with anything, but that's what we're expecting to happen. And then you look at the
Okay.
10-year Treasury, which also just directly ties right into it as well. It's the inverse of the bond market. So as the 10-year treasury goes up, interest rates are getting worse. Okay. And so this is where we were leading up to the rate cut, right? 2 weeks ahead. I mean, we got all this ground. Oops, I just messed it up there. We gained all that ground. The same thing as the bond market, just going in our favor, where the 10-year treasury was coming down, coming down, coming down. Boom, rate cut, news, bad news for us. Let's pop back up. And now we're seeing it at a pivotal level here where it just broke above this resistance line. And so we really want to continue to close under this 25-day moving average to continue its downward trend, which means better rates. But so now right now we're just battling. So rates have a lot of room to go. If this doesn't break below this and it closes above this today, it could continue upward here. And so upward on the treasury, 10-year treasury equals worse news for rates. And right now, you can see up here, we're down 15 basis points on the bond market, and we're up 3 basis points on the 10-year treasury, which we want it to continue downward.
Okay, gotcha. All right, that makes really good sense. So in terms of interest rates, so there's a lot of things that affect people's ability to get interest rates, or excuse me, to purchase a home. Interest rates is definitely one of them. And credit can also affect what a person's interest rate looks like. What are some of the other factors that affect a person's ability to get a mortgage?
I mean, you kind of nailed it right there. It's going to be interest rates, obviously, is going to be how much you're going to qualify for, right? That's a big one. Obviously, credit score is huge as well. All loans are basically based on your credit scores. So lower the credit score, the higher the interest rate, the less likely the system might approve you, because everybody runs your loans, unless it's like a non-QM loan, meaning like a bank statement loan or some off-the-wall type of loan. Everything's run through an automated underwriting system. And so the higher your debt ratios are, you can have somebody with a 660 credit score that the system will not approve at like a 42% debt ratio, but somebody with a 750, it might approve them at a 49% debt ratio. So two borrowers, same income, same debt ratios, just different credit scores. Not only are you getting a worse interest rate, but also your likelihood of getting approved is worse as well, especially on conventional, because conventional loans are a lot more sticky with the risk factors when it's analyzed in the system to approve, right? We've all gone through that. Like, hey, let's flip this to FHA. A lot easier to approve. The debt ratios are easy to go with, but a lot of times it can be a little bit higher rate and it has higher PMI, depending on the situation, things like that. So credit score is the main factor. And then, of course, higher interest rates, the less you're going to qualify for. And so that's another thing we just talk about is what happens when rates go down. Well, everybody thinks, oh, I can qualify for more of a house, right? But there's a statistic that shows for every 1% lower interest rates go on mortgages, another 5 million people qualify to buy a house across the country. Now, not all 5 million people are going to buy, but what does that do to the buyer pool, right? It just increases the pool, or your competition, so to speak, exponentially. And so by the time buyers are instantly in the market, there's a time between all these buyers that are now looking at buying a house to the time that these sellers say, hey, rates are lower, now might be a good time to list my property. So there's a delay between the time that inventory comes back on the market and the time that all these buyers come into the pool, where it's creating basically a little bit of a frenzy, right? So now sellers don't need to accept the first offer that came in 3 weeks because I got multiple offers today or this week. And so we don't need to do seller concessions because I have a backup offer right behind yours at full price. That's the kind of environment we go back to. If we remember during those COVID days,
right?
So frustrating, right?
That brings up a really great point. Is I have several, on the order of 3 dozen buyers that are telling me, oh, I'm waiting for the market to shift. I'm waiting for prices to come down. I'm waiting for interest rates to come down. And like you, I get called when the feds make an announcement of interest rate cuts. I get people saying, hey, we want to start looking for a house. They're cutting rates. And it doesn't translate to going from 7% to 5%, which is what they think in their head.
Yeah.
But if rates came down to where the affordability model looked better for a lot of buyers, my prediction is just like you said, you have that many more people that are qualified at that point. And it may not be exactly what they want, but it's enough for them to say, geez, maybe it's not going to get back to this 3.5%, 4% market, but
Right.
they're down. And let's go buy a house.
Yeah.
I fully anticipate that this is going to lead to a lot of buyers coming out simultaneously, which, like you mentioned, during COVID, we had a rush of a tsunami of
Yeah.
buyers coming in, and housing prices, because of the limited inventory at that time, they began to tick up. It was just the same old supply and demand chart that we all are familiar with. And suddenly, the savings that they were making because of the slight reduction in interest rate, they're making up because of the increase in prices. We were back to a model that's hey, who's going to put the best offer in? Who's going to go non-contingent? What's your offer look like compared to another? The roles quickly shift in scenarios like that as we go from maybe on the cusp of a buyer's market to back in a seller's market. And then all of a sudden people list, so you see more listings because they see, oh, wow, Mary's house across the street sold in 3 days, and
Yep.
they received several offers and ended up settling above asking price.
Yep.
And so Jeremy's saying exactly what I anticipate and what other professionals, what the market indicators, what they all forecast is if interest rates really do settle, we're going to see a rush on the housing market leading to housing inflation.
Hmm.
What would your advice be if someone needed to buy a home right now
Yep.
and their interest rate's just not quite what they thought it should be
Right.
or what they'd like it to be? What is your advice or strategies that
Yeah.
they could utilize to get into a
Yeah.
home now?
Yeah. Well, and this is going to be a totally cliche, I guess, answer or mantra, but the whole marry the home, date the rate. I mean, it rings true. So you have these people, what's the whole purpose of them waiting? Well, they think that the rates are going to come down and my payment is going to be lower and I'm going to be able to afford more of a house. But what they're not anticipating is what happens when rates come down and the inventory is still fairly limited. Well, it's pushing prices up. And especially in our market, we're still seeing year over year growth,
Yeah.
5% plus growth in 1 year. Let's say you want to wait for a year and you're talking about a $500,000 house. Well, you want to buy that $500,000 house, you want to wait for rates to come down 0.5% or maybe even a full percent. By the time that happens, it doesn't take much reduction in rate costs to really get people in the market to be like, hey, things are going. I hear everybody's starting to look now. That's the talk. And so all these people are rushing out to buy. Applications are actually up, I think it's like 18% just in the past couple of weeks, just with the rates coming down a little over 1/4%, 0.5% in mortgage rates. So imagine if it comes down a whole point that you're waiting for. Well, yeah, you might save a couple $100 a month on a payment at 500,000, but what you're not going to realize is that house that was 500,000 6 to 12 months ago is now $530,000. And so $30,000 more on a house price just on a monthly payment basis. I mean, that's another, let's see, 60, it's like almost another couple $100 a month in payment cost. So you've totally lost all of your savings that you would have got by getting that lower rate and waiting. And so the whole marry the house and date the rate is you want to buy the house today. We're going to take advantage of the best of both worlds. We're going to get the house today. There's lots of concessions out there. Typically, sellers are willing to pay closing costs and buy down points right now. Builders are giving 20, 30 plus $1,000 as incentives. So you can buy the house at today's prices, and then in 6 to 18 months, you refinance, the rates come down. You're going to get that lower rate as well, and you're not going to get that $30,000, $40,000 price increase in the meantime. You're going to take advantage of both. So you're going to get all the
Yes.
equity. You're going to have a higher payment for a little bit of time, but you're going to refinance that and you're going to drop that payment down to that lower interest rate. So you get both. It's just a little bit of a waiting game. That's the best strategy I tell everybody right now, as far
Right.
as like waiting.
Timing. I get that all the time. Shane, when is the best time to buy a house? And I've got to the point where I say, well, 2011 was the best time to buy a house. But if you're in need of a different housing situation, if you need a bigger house, you need to downsize. If this is something that you really need, waiting for the exact right time, market timing, it doesn't work in the stock market and it never really plays out in the housing market as well. The best time to buy a house is when you really need a new scenario to work for you. And down the road after your purchase, no doubt rates will come into alignment with something more favorable. And at that point, you refinance. So just like Jeremy said, you buy the house, you marry the house, but you date the rate. It's a temporary situation. It's a tool to get into the home, which really is what's creating the situation that you need. Okay, well, I think that's great out there for everybody to understand how this interest rate is going to affect people. It's not going to be this massive cut in rates.
Yeah.
I don't see that in the foreseeable future
Yep.
as being a strong tool. I think that a really strong decrease in rates would cause overall inflation. And that is something that the government, the feds are really looking out for not causing, because as we know, we've been dealing with inflation for a little while. Well, hey, I think that's it. Jeremy, is there anything else that you'd like to say to people before we call her quits here?
Yeah, I think you just hit the nail on the head there. Yeah, even though the Fed is, they call him too late Powell for a reason. He's always too late to raise rates. Then he did raise rates and he left them too high for too long. And now he's very slow to lower rates. I mean, we're still probably the highest, basically, Federal Reserve rate across the world right now. We're like in the top three, I think, highest interest rate. All these other countries are probably at least 1 to 3 points lower on the rate cuts ahead of us. And yeah, inflation. The thing I see too with the inflation numbers and everything, it's not accurate. I mean, it goes back to trusting the government, all that kind of stuff, right?
Right.
But the numbers they're using numbers that they want to use. They pull things out that shouldn't be pulled out of the calculations. They add things in. They use bogus calculations on some things. So yeah, inflation really is not as high as they make it sound. That's why they're now going off of the jobs data. Like the unemployment rate is continuing to rise, and so they're really trying to offset that. That's really the catalyst that's been for the advocate for the rate cut they made. But yeah, over time, they're going to continue to cut those rates. I expect that over the next 18 months, again, Jerome Powell's tenure he's basically done in May. And so Trump will appoint a new Federal Reserve chairman. He's also putting in other board members in there, kind of handpicking them and stuff. And if Trump had it his way, the rates would be cut 2 to 3% lower.
Yeah.
Totally. So we might get 1 or 2 more rate cuts this year, maybe one first part of the year. But once Powell's out, I anticipate with a lot of these dovish Fed members that are coming in and the new chairman that comes in, that we might get a couple back-to-back 0.5% or 0.75% rate cuts. Like I wouldn't surprise me if that happened next summer. And so as that again happens, depending on what's happening with all the other economic data and stuff, yeah, rates don't just come down on mortgage rates by a whole point. It's a slow thing that happens with mortgage rates over time. And so, yeah, could they come down a whole percentage point in the next 12 to 18 months? Yes. But what's happening in that meantime, like we talked, is people start hearing this. They hear multiple Fed rate cuts. They hear interest rates are lower. It's all over the news. That gets the people out in the market. So waiting a whole year to purchase, even though rates have only come down, let's say maybe another 1/4 or 0.5%, it makes a big difference, the market pushing the prices up, because again, in our market, we're a little unique here. And so our values are just continuing to go up. And so I say take advantage now, get pre-qualified. There are a lot of extra programs out there that kind of went away and they came back, like the old stated income loans, where we didn't have to document income. I know for a lot of people listening to this may not even know what a stated income loan is, but we can do bank statement loans now for self-employment people. So we just add up the total of your bank statements for 12 months. And typically we just cut that in half and then that's your income. So a lot of people don't always show income on taxes. that represents what they really make. So that's an alternative way to qualify people. We still have low down payment assistance options, concessions from sellers. We can do buy downs, temporary buy downs where you get 2% lower in the first year. So there's lots of options out there for people now. And that's a way to offset the higher rates as we do that 2-1 buy down. So let's say your rate is 6.25 today, but we start you out at 4.25. Well, that's way better than rates are right now for the whole first year. And then maybe it goes to 5.25 the second year. And then the third year, it goes to what that actual fixed rate is. Well, by then, we expect that rates maybe are even down in that lower mid 5%, hopefully. And so then we can go back in and lock you in at that long-term rate. So there's a lot of solutions to help people navigate the little bit higher rate environment stuff. But yeah, don't wait, because imagine if you said, I want to wait back in 2019.
That's right.
Today, I mean, prices in the Boise market went 20-40%,
and it priced out a lot of people that were hesitant and sidelining, waiting for a more favorable purchase solution. The Treasure Valley, our market, it's been proven it's not going to settle down anytime soon. We're only expected to grow. The forecasts only show growth. And if we're tight on inventory right now, chances are our housing prices are only going to increase. So if housing prices have a big thing to do with it, and they do, I would certainly recommend taking Jeremy's advice and coming in, and we can work out rate buy downs from sellers. Are often willing to work with the buyer to do a rate buy down and pay some of the closing costs. This removes the big barrier to entry on a housing market. And then down the road, if we're anticipating these lower interest rates, we can take care of them with the refinance. So now is probably the time. If you have a need, if you're looking to move, now is the time. Okay, well, hey, Jeremy, let's wrap it up right now. I'm going to have a way for you to get a hold of Jeremy right after this. I appreciate your help today, Jeremy, and let's go to lunch next week.
Sounds good, but as always, great chatting, and I look forward to it.
Okay, we'll see ya.
All right, take care.
All right, bye-bye.
All right, I hope you guys took a lot from this. The basic takeaways are, while the feds did cut rates on the 16th, I keep forgetting the exact date, the 17th of September, it's not going to translate into huge savings. But let's just say, and they are planning on doing several cuts over coming months. But let's just say that they did do something substantial, and rate cuts equated into maybe a 2% declination in rates. Well, that would look like, if we're sitting at 6.5% right now, that's 4.5%. What do you think would happen to everybody? I can tell you, working in this industry full-time for over 20 years, I get calls every time something like the rates get cut or home prices come up or something about the real estate market hits the news. My phone rings. They want to know what I think about it or how it's going to affect them. Here's what I tell people when I talk to them about, they want to buy a house, but the rates are too high, and when they look at their mortgage payments compared to where they're living now, the rates they have, if they have a 3.5% rate and they're going to 6.5%, that's doubling. Plus home prices are a little more expensive. That's a little bit a tough pill to swallow. I get it, but if your circumstances have changed, along with your housing needs, perhaps now is a time to really sit down and look at what that looks like. You could get the house that really works for you, your family, or your situation right now, and then down the road when rates are more favorable, that is when you refinance. So it's a temporary solution to get you into a home that you really need. Listen, I've got a lot of interviews lined up in the coming months, and I'm going to also talk about great reasons to live in Boise, why people tell me they love to live here. I've been an Idaho native my entire life. I've rarely even been out of Idaho. And so I know a lot about it, and I know pretty much everybody here. So until next time, keep it real.
Be strong.